We are on our options myths series for the summer, and I would like to go over today options myth number 4, which is very timely because we're in a generally very low volatility time right now. There's been recent small spike, but it seems like every time options volatility comes into the market and the VIX jumps, it just takes a couple days to evaporate and we're back to these very low volatility times. And so here's options myth number 4. I can't make money in a low options volatility market because the market is not paying me enough for my risk. And that statement is partially true. The market's not paying you a lot. If you look at an iron condor, for example, and you look at the pricing you'll get in a low volatility environment, it's going to be a lot worse than the pricing you're going to get in a high volatility environment for the same risk. And so, yes, the absolute prices of options have come down across the board. Now, so is that a true statement? You can't make money in a low volatility environment, you're not getting paid enough for the risk. And the answer is, it might be a true statement, but the evidence is it's actually an untrue statement. And we'll look at that in a minute. Because if you think about what options implied volatility is, it is really a projection of the volatility of options going forward. So it is a projection, by definition, if it's a low volatility time, that the market is not going to be very volatile. So can you make money in that environment? Well, let's think about it. It's a projection, and it's a projection that could be inaccurate or it could be accurate. So let's say there are really two cases. One case is, as low as options volatility is the market actually less volatile than that? If that's the case, then you can make money. If, however, you enter into short volatility positions, negative vega positions, and the market is more volatile than the market had expected at the time you bought the options, then you tend to lose money in those environments. So let's take a look at what's actually happened. Here is a chart of the VIX, which goes back to 2009. When options volatility was initially very, very elevated coming out of the financial crisis of 2008. As you can see, if you look at this chart and you look at the different moving averages, that there has been a clear downtrend of options volatility since 2009 through to today. Of course, it'll spike now and then, but the spikes go away pretty quickly, and you get to see throughout this period a continued drop in options volatility. And in fact, you take a look and zero in on the last 2 years. At the beginning of 2016, when the price of oil was tubing and it was bringing the rest of the market down, there was a very high volatility level, well, relatively high volatility level in the high teens and 20s, and that ended up coming down to now the low teens and even single digits. Sometimes over the summer it has actually gotten into single digit territory. So options volatility is cut almost in half since the beginning of 2016. However, when we look at our own options trading desk results, which I think mirror most people's results throughout the options trading world, we struggled in 2016. Our first 9 months of the year were actually negative. Not a huge negative number, but it was negative enough. It certainly wasn't positive, and we're in business to make money, not to lose money. On the other hand, through the first 9 months of this year, now I know it is August, and you would say, why is he saying 9 months? And I'm saying 9 months because most of us are trading September and October right now, August pretty much being done, and in fact September is already well underway. So if you look at the first 9 months of this year, we're actually having one of the best years we've ever had on our trading desk. So, what's causing this? And I would say this graph of implied versus historical options volatility gives you a very good idea of why. If you look at the implied volatility over the last year and a half, it's consistently above the actual volatility, also known as the statistical volatility, what actually occurred volatility-wise in the marketplace. And so you can see that even though the volatility, the implied volatility dropped over really the past 6 years, the options, the actual statistical volatility, the historical volatility has dropped also and consistently stayed under the implied volatility. So generally speaking, we should be able to make money in those kinds of periods of time. So options income trading profitability is not really determined by the absolute level of options volatility. It's determined by the relative level of the implied volatility to the historical volatility, which is also known as statistical volatility. That is what's going to determine it. In other words, if the market acts pretty much like the options market thought it was going to act, we have a very good chance of making money. It's only when we expect the market to act much less volatilely than it actually does act, that's when we run into trouble. But the market's pretty much been staying in this low volatility regime, which is why we've had one of the best years that we have ever had on our trading desk. So don't fall for this myth. It's a problem to fall for this myth because you may tend to not to want to trade during these periods. But the history shows that you'd be giving up wonderful opportunities if you did not trade in these low volatility times. Even though you're not getting paid as well, the profits are still there, and I think we have demonstrated that. So in low vol times, keep calm and trade on. Don't abandon your trading during those times. You actually can make some very good money in low volatility periods if you're careful. You follow your plan and you make sure that you maintain your risk management discipline. So hope this inspires you to stay in the market in low volatility times, and we'll see you next week.